Thanks for tuning in for Investment Insight today on this little wet Monday morning. We're doing a little differently this month, of course, because we're doing our normal Tuesday meeting. We're going to do that today at 10 o'clock here, and then change the McMinnville time to 3 o'clock instead of 6 o'clock for McMinnville tonight. But thanks for coming in today, guys. I guess I'm going to look to the left a lot. Kimberly, you sit over here because I need someone to look to the right. And I'm serious. Come on, Kimberly, come on over. I need somebody else I can look at. And so, but those watching online, everybody decided to sit on one side today. So there's a depth in the wind. So we're going to move the marker board this way too. I'm just kidding. That's some fun. But thanks for tuning. Merry Christmas in advance to everybody here today. Obviously, it's been another good year for investors, and something to be thankful for, as well as family during the Christmas season. So a couple of little fun facts to talk about. I don't know if you guys know this. You guys probably know this. He was real, sort of. Folklore may have turned Santa Claus into a toy distributor, a man's a sleigh by 8 reindeer. But St. Nicholas was actually born in the year 270 AD. He was the bishop of the town of Myrna, which is now in Turkey. You know, if you read the Bible, a lot of the early churches that talk about, Paul talks about in the New Testament, are actually in Asia Minor, which is now Turkey today. And so there's a lot of interesting history there. But what he would do is he had a reputation of being an anonymous gift giver. So if you really want to be in the Christmas spirit, the best way to actually emulate Santa Claus is to not put your name on the gift, but just randomly acts of kindness. You know, one of the neatest things about our country has been the change to where a lot of people are giving big tips to waitresses and waiters as a way to gift, or doing things anonymously, you know, paying the way forward. You know, you go into the Starbucks and they pay your coffee ahead of time. You don't even know who did it. That's really kind of the St. Nicholas reputation. And it goes back to that scripture of, you know, basically, you do it now, nobody knows about it, you'll be rewarded in heaven. Everybody knows about it here on earth, you got your reward, you know. That's a very common. So interesting word, St. Nicholas is the world's most popular non-biblical saint. He has over 2,000 churches dedicated to him in France and Germany, and 400 in England. Another thing I like about St. Nicholas is he is the patron saint of banking, pawnbroking, scholarship, pirating, butchery, sailing, thievery, Haberdashery, orphans, royalty, and New York City. So a lot of different patron saints out there. I'm not as familiar with saints as I guess I should be. In Europe, before the 16th century, gifts were not exchanged. But on December 6th, in Germany, they started celebrating giving gifts. So we're actually, what is today? December 6th. Also my daughter Madeline's birthday. So this is actually when they traditionally would exchange gifts. But later, German Protestants began celebrating Christ Kindle on December 25th, which is where we get the feast day of the Christ child is what it's for. And so that's where that comes for. So that's what we were going to, listen to cool fun facts today. What I mainly had to talk about, anything, you know, Dennis, Linda, Brent, Cheryl, anything you guys want to talk about is great. But please bring up what you guys know first. Where are the markets going from here? What's going on with the stock market? Why are we seeing a little bit more volatility now than we have previously this year? And what's going on there? So, where do we find ourselves now? So, if you don't mind, Genesis, if you want to hand out these little handouts, keep one. That's the rest of it. These are a little hard to see online if you're watching live stream. But one of the things that this shows you is this just shows you from 2012 to 2021 what the average return has been in different asset classes. And this is through December 1st. So this is through about half of last week. Kind of tells us where we were as a market. So just to make it easier for people that are watching at home or maybe listening, so commodities have been the best performer this year with a 30.7% increase. Commercial real estate is next with 23.2. U.S. equities at 22.1%. Europe 9.7%. And of course, some of the worst performers are Chinese equities, negative 19.1. Developed market debt, like Treasury bonds, negative 6.1. Emerging market equities, negative 4.1. And emerging debt, negative 2.9. So, these are, when we look at investment returns, it's support. But look at, this is interesting to me. Look at last year, right? What was the worst performing investment last year? Commodities. Who's the best this year? Who was the second worst performer last year? Commercial real estate. Who's the best performer this year after commodities? Commercial real estate. One of the biggest things about rebalancing a portfolio is it's amazing how easy it is if you will rebalance your portfolio to help your returns. If you look at this chart here, one of the simplest things an investor can do is rebalance whatever didn't do well this year. A lot of people look at stuff and say, oh man, I didn't make much money this year. I better what? Better change what I was doing. Better give up. It's kind of like, I'm a runner and a swimmer. It's like, you know what? I didn't run that mile very well. I better just stop running. Now, if you want to get a better runner, you got to do what? You got to run more. You got to do better. And so it's always interesting whenever the market declines, I'll call people and say, hey, do you want to buy while there's a discount, while things are on sale? No. But then when things are good, people want to put money in. And we should think the opposite way around in terms of making returns on investment. But what's interesting about this year is, obviously we know China's not doing well because China's turning more communistic. China's made the decision to go away from capitalism and start arresting their wealthy people. Well, guess what happens to their investments if they keep arresting all the rich people? They're going to go down. And that's how it works. It's funny, communism led China to where they couldn't feed themselves. So they embraced capitalism. And now that they can feed themselves, what do you think is going to work? Communism? It will not work. It's just a matter of when, not if. And bonds are having a rough year because inflation's heavy. If Genesis back there is locked in at 1% on a bond, and the rates go to 1.5%, would you want to buy her bond? What do you guys think? If you go to the bank and they tell you at a CD, we'll give you 1%, and another bank says 1.5%, what do? What should you do anyway? You should switch banks because they're both FDIC insured, they're both protected. I mean, think about it. First Vision Bank and Traders Bank and Citizens Tri-County Bank and all, none of those three banks offer anything different than the other ones from a mathematical standpoint, right? It's just, we pay this, you pay that, right? So it's all about that interest rate. That's what really makes the difference. And so what happens is, in order for people to buy Genesis bond or her CD, they pay less. Because if she's locked in at 1 and rates are 1.5, they're going to pay less for hers because they're going to try to switch from this one to that one. So the only way to do it is to make the math. So they're going to bring her yield up to 1.5 by reducing the principal. They'll reduce the value. So instead of her, if it's a 1-year CD, instead of her getting back $1,000, she might get 999.5. So that would be kind of how it works out on that. So that's how it works there. So, but one of the things that has helped our investors is their TIPS. So Treasury, which are not listed on that sheet, but CHIPS, Treasury Inflation Protected Securities. Those are bonds where your principal goes up if inflation comes in. Now TIPS this year have a positive return. So if the government keeps spending money, if inflation keeps getting higher, one of the ways to protect your assets is buying what's called a Treasury Inflation Protected Security. These are investments that, let me give you examples. So let's say inflation is 5%, and normal inflation is 2.5%. What they would do is if Brent over here puts $100,000 in one of these things, and inflation comes in higher than 2.5, he gets the difference. So instead of walking away with $100,000 in principal, he'd have $102,500 plus the interest that tip is paying. That's a way to protect yourself in inflation times, as well as buy commodities, right? If you think about it, when I've done my research, this is just my opinion, the best performing investment in inflationary times is commodities, because they are the truest measure of inflation, right? Who really likes paying higher gas prices? I'll tell you what, if I own the oil companies, I do. Right? Because guess what their stocks are doing? Imagine if you could have bought a barrel of oil for $20 a barrel a year ago and sold it today for $80. Only problem is you got to do what? You got to store it, you got to get it there, you got to be an oil company, right? Which is not easy to do. But that is one of the truest ways to protect your assets when you have inflation. And so that's what we're seeing this year right now. The other thing, of course, is what's going on this year? Well, if we look, okay. Sorry, I did tips again. So if we look at this year, let's talk about corrections. What do you guys think? What is typical? Some of you guys have come here several times for Investment Insight and Coffee Club. What do you think how many corrections do we normally get in a year? How many times does the market tend to drop? I mean, not daily. A correction is a 5% drop, a 10% drop, and a bear market is a 20% drop. Now here, because they have names for it, that means it probably what? It happens what? What do you guys think? Often, right? I mean, you don't name something. If I call my kids' names out, Madeline's birthday's today, so if I say, hey, Madeline, you guys know what every person's favorite word is? It's your name. Most people, when they do a survey, if they put a word down, the most favorite word to hear is their name. You know why that is the case? You've heard that word in your lifetime more than any other word in your life. So when I say, hey, you gal over there, or I say, hey, Sharon, hey, Lynn, how you doing? That's why one of the things that's common courtesy is to say someone's name. Hey, Dennis, that's one of the things you want to teach your kids. And so, but when we look at corrections, what do you guys think? What do you think? How many of these do you think we have every year? The 5, the 10, and the 20. So typically, we have 3 5% corrections a year, 1 10%, and a bear market every 3.5 years. Now this is an old statistic, but it's pretty much true today. And so it's very normal for the market to drop during the year. You know, what my hairdresser used to say that the stock market is America's yellow streak. Typically speaking, we live in Tennessee, the volunteer state. If Manchester was flooding right now, I know that people here in town would be going out helping other people. But that's how we treat our fellow people. But from an investment standpoint, when the market drops, people tend to have a different opinion. They tend to get a little more nervous. And so, but corrections are very normal. What's been different about this year is we've only had, if the market stays up today, 1 5% drop this year. We're supposed to normally get 3 and 1, right? We've only had 1 5% drop this year. Now, does anybody remember how much money their investment portfolio made in 2014? I mean, I can tell you, I won't. But the thing is, I can tell you what our model did. But most people don't remember what happened yesterday. So since we've had such a calm, easy market, since the election, if you guys remember, the most volatile time we had was February this year. We had 1 5% correction. And right before the presidential election, we had a real volatile market. Why do we have a volatile market before the election? Anybody know?
Wasn't sure what was going to happen.
Nobody knew who was going to win. Even though everybody, all the polls indicated that President Biden was going to win the election by double-digit points, he only won by 0.5% based on the Electoral College. He won in 3 key states, and they turned it by 0.5%. And so when we look at the reason why the market was volatile, there was this word. You know what it is? Yeah, the unknown, uncertainty. Everybody in life hates uncertainty, even though life itself is uncertain. While you're going through today, we're all sitting here. What if that tornado would hit this building? I mean, you don't get up in the morning and you're like, I'm going to get hit by a tornado this morning. Right? Nobody actually plans. I mean, Kimberly back there, she likes to do these burnouts with her tires. She sits there on her neutral, kicks it in gear, and then she goes 80 miles an hour. So this morning, on the way to work, she lost a tire. She doesn't actually do the burnout, so I'm just messing around. But she got a flat tire. So that was an uncertain morning, and that kind of changes your outlook today, right? If you have an uncertain morning, you can have but she's still smiling. She doesn't seem to be in a bad mood. She's not ready to come in. And now she's even blushing. So poor Kimberly. She's got to sit on the right side, and Jesse gets to hide behind the TV. And so that's what we look at uncertainty. That's the biggest thing. So if we know that normally the market's more volatile than it has been, what do you think is likely to happen going forward? If you're making a prediction, it's probably going to be more volatile going forward. When we don't know, past history is no guarantee of future success. You see that disclaimer in every one of the investment things. But if we know in the past the market goes up and down quite a bit, and it hasn't really done that in a year and a half, it's probably time, right? And you guys that have been here today, we've been investing together for a long time, and we've seen some of that volatility, And so there's no reason to believe that's going to stop going forward, and we don't want it to, because if you don't have volatility, you can't make that much money. If the market just does this all the time, our rate of return is going to keep going down, because the bank rates, which have no volatility, their rate of return is what? About 0. Whereas here you can make some money, and part of that's because you can handle the volatility. You don't make any money without taking risk. That's the whole point of investing. So, what's going on with this Omicron, which I said wrong, variant? What's going on with this COVID variant? So according to the Guardian newspaper last night, out of England, this variant has been detected in 38 different countries. 38 different countries have the Omicron variant. The good news is, this was even out of this report this morning, is it appears to have infected people far easier than imagined. There was a story out last night, which we know if it's true, we believe it's true, is 2 people were in a hotel room. They were across the hall from each other. Neither one ever left their room. But both, the one in that room infected the one in the other room. While they were, basically they never had any contact. They never touched each other. They never saw each other. But they actually believe it somehow passed the ventilation over the other person. Now, so that's always a little scary, right? But here's the good news. So far, it's bypassing the immune system, but it's not nearly as deadly as the Delta variant. So if you guys remember, this might not be what happens, but anybody remember the flu, right? Who likes the flu? Nobody likes the flu. Well, when the Spanish flu came around in the early 20th century, 1900s, it killed 3 to 5% of the entire world population. So that means if there were 100 people in this room, 4 people would be dead. It was the most deadly virus since the bubonic plague. Okay? Well, this new variant apparently takes over all the COVID variants, but it doesn't tend to kill people. Like, to my knowledge, we don't know of anybody that has died yet of this variant. So imagine if the dominant strain of COVID, you can catch it easier, but it doesn't kill you. to me, that would be one of the easiest ways to get immunity for this virus across the world. If you could get something that wasn't, it's kind of like, you know what anybody know what a vaccine really does? What does a vaccine do?
Builds immunity.
How does it do it?
Got the virus.
Yeah, it gives you a little bit of virus, enough where you don't die from it, to where you can fight it off. It just gives you enough to do whatever it needs. And so, when we're looking at, that's what this potentially could be, or it could be something different. We don't know. It is mutating, so it's hard to say. But economically, so COVID has not been bad for investors. If you think about it from an investment standpoint, if you look at the whole, if you had a diversified portfolio, has COVID cost you money over the last 2 years? No. Because think of it this way. Who can handle COVID better? FedEx or a local business in Manchester that delivers stuff? FedEx, right? Because they have the systems, they've got the people in place. I mean, think of it this way, right? So we hold our money with TD Ameritrade, Charles Schwab. Do I want to be physically holding people's money here? Could you imagine the level of security we'd have to have in our business if we held money for people at this office? Could you imagine how many security guards would have to be sitting out here? I'd have to have a tank out here, some Uzis, because we're too close to the interstate. You understand what I'm saying? It would not be an ideal situation. And so one of the things about big business, people don't like big business, but one of the positives of big business is they can scale. And what has COVID really done? Well, COVID has caused things to happen quicker. So let me give you an example. Let's talk about Walmart, right? Has anybody ever been to Walmart? Okay. So Walmart, what is the most common thing you hear about Walmart?
Prices.
There's no cashiers. I go to Walmart, which I haven't been to Walmart in a while, probably 6 months. There's no cashiers here.
You used to have the one.
Yeah, they used to have one cashier. So what everybody, if you think about the brand of Walmart, what really do you hear? In my mind, I'm going to walk in this big store, I'm going to get all this stuff, and there's going to be no one to help me check out. You know why I don't go to Walmart? Because imagine 4 kids, all 17 months apart, sitting there waiting around candy, gum, and sticker stuff. And then imagine the belt I'm wearing and me going to jail for using it, right? And so that is the point when we look at Walmart. And so Walmart's changed. If you guys didn't know this, Walmart now does home delivery. So you know why I go to Walmart? The last time I did a Walmart order, for $10, they brought all the groceries to my front door. So what COVID did to Walmart is, they were already moving to where, think about this, right? Amazon delivers everything to your house. But they got to get it from a distribution center to your house. What advantage does Walmart have over Amazon?
Local store.
They're already here. So Sam's Club, they closed a few Sam's Club stores, and they turned them into distribution centers. Because Walmart's sitting there saying, people don't want to come in the stores anymore. But guess what? We've already got all the stuff within 3 miles of their house. We've already got the staff to what? To deliver it. So you think about what COVID did to Walmart is, they were in the process of doing that. And then when COVID hit, what did they start doing? Like Kimberly on the car. They hit the gas pedal. They hit it up, right? And so, I'm just joking with Kimberly. She doesn't drive fast, I don't think. But that's what they do. And so, that's exactly what Walmart did. And so from an investment standpoint, COVID was very positive for Walmart because their business grew. They have more sales today than they did when COVID hit. Whereas when you look at some of these other businesses, they don't exist anymore. They're gone. Right? And so when we look at what COVID did is a company like JCPenney is going out of business unless they do what? Deliver online. Deliver to your house. If they don't bring it to the customer, they're going out of business. So what if, of course I like deals. And so you guys know Macy's, right? So when COVID first hit, I was buying all these suits from Macy's. I could buy this jacket, which I think actually I did, for $20. Now, guess how much that jacket should retail for? $400. Because everybody was working from home, what were they not doing? They weren't buying suits and jackets. They weren't buying a fall wardrobe. So Macy's sitting with all these clothes. They got all this. They got to keep up their building. So they sold the clothes at less than what they paid for them, just to what? To stay in business. To have, $1 coming in is better than, than nothing. And so it's kind of ruined me though, right? Because I need to buy some more jackets. And so now I look at the price, and I'm like, I can't spend $400 on a jacket when I spent $20 a year ago. It bothers me, right? Because I become spoiled, right? And so you look at Macy's, here's a great example. What Macy's started doing is they started turning their stores into distribution centers. You want to do a return? Instead of them paying to ship it back, why don't you bring it to the Macy's? We'll handle it there. And so if I go to Macy's, they actually carry no 44 longs. Go up there, they said we're at Macy's, go in and look for 44 long jackets. It's the size jacket I wear. I can't find them. And here's the crazy part. A lot of times it'll be more expensive in the store than it is online. So this is weird, but I've gone in there before, tried it on, taken a picture of what I wanted, and then ordered it online. Because it makes a big difference. And so, but you see how what's happening is their business is completely changed. And so, but that needed to happen, right? I mean, did anybody believe that these big department stores were still going to be growing like crazy? No, because think about it this way. It's a bunch of empty space that's not being used. So for Macy's to survive, the only way Macy's survives is if they pay less rent and they turn their store into more of a warehouse. Here's the worst part, right? Here's Macy's. They got granite floors for a warehouse. You understand what I'm saying? That's not a great use of money, right? Because when they're competing with Amazon, what do you think Amazon's warehouse is on their floor? Concrete. They never put a floor on top of it, right? Because they're just trying to build something and get out, It's kind of like when you think about, why do schools cost so much money to build? Well, you're making them out of brick, and you're making them super nice. Is your goal to make the school look nice, or is your goal to educate the kids? Because those kids are going to leave that school, and they're probably going to work in a different environment. And so, what COVID has done is it's changed, revolutionized business. Instacart, Zoom, Amazon, Walmart delivery. It has changed the entire way you receive goods and services. Instacart, I use Instacart every week to get groceries for my kids. We use Instacart to get your food here. Because here's the math, right? I pay $10 a month for Instacart. If I have Kimberly go to the store and she gets groceries, how much do I pay her an hour? How much work do we lose? Whereas now, they're just dropping it off in the front door. It's an economic decision. Plus, I go to the store with my kids. One of us gets sick. I miss a day of work. It's not working. And so, that is one of the things back here. So, what is really going on with COVID is not related to this COVID virus. What I believe it's related to is, A, we have not had a correction in a long time. People need a reason for correction. People feel better after a correction. It's like me. If that $400 jacket went down to $300 jacket, I feel better. Even though it was still $20 a year ago. Because you got a what? Dude, why don't they do coupons? I always give Susie a hard time because I'm like, oh, I got a coupon. It's fake. They're just trying to do this to get you. That's all it is. It's a plan. And so that is there. So what is really going on that's causing the volatility of the market afterwards? And that is the typical culprit, which we typically see. It is the Federal Reserve. They typically cause or help or hurt. Back after the Great Depression, the government said, you know what? We don't need to be in the business of basically deciding what happens with money. We need to let somebody else figure out the money thing. And they basically said, we're going to turn this over to the banks of the United States because they know money. It's kind of like the worst part of the government is the government says, we're going to take over healthcare. And started turning over healthcare to people in healthcare. Oh, hey, we're going to take over gun control. Instead of turning it over to people that actually know how to use guns. You know? I mean, I think everybody would agree that people that are mentally unstable shouldn't be allowed to own firearms. Because that tends to be the people that are shooting up schools and killing kids. But because everybody's so worried about government control, they won't make a change. And so that is because the government continues to do things that are right. So the Federal Reserve here, when COVID first hit, what did they do, guys? What did the Federal Reserve do when COVID first hit? How? They just said they printed more money. How do they do that? You got to remind me to repeat the questions because everybody online is listening and they don't hear the questions. So that's what I just said. How did they print more money, ladies? Anybody know? Did a bunch of guys show up at the press and they're like, woo, they started drinking, they started having fun, they started going crazy? What actually happened? Do you receive physical money anymore? No, how do you receive money?
Notes.
Digital, right?
Digital.
It's all digital. I'm worth all this money in a computer somewhere. I'm not worth the money in like dollars. I remember when I was a kid, I used to mow lawns. I hated the bank, so I kept the money in cash. So I had a lot of acne when I was a kid, so I had a little proactive thing where I hid my money in. And I remember I had $30,000 in cash in my closet. And the worst part about it was every time my closet door was shut, all that money would just start raining down. Which is not a practical way to hold money, right? Because eventually you got to find somewhere to put your money that doesn't cause it to rain. So what the Federal Reserve did was they started buying mortgage bonds and U.S. Treasuries. Now, here's the funny part about it. So, the federal government has all the money, but the Federal Reserve controls all the money. So the Federal Reserve starts buying U.S. government money, which means they print it, they what? They buy it. Then, when I go out to get who gets a 30-year mortgage from a private individual? Where do the mortgages come from? No, they don't come from the bank. The bank gets it done for you, but who actually buys the mortgage? Huh? You're saying yeah, so they started two entities called Freddie Mac and Fannie Mae. Yeah. And then Ginnie Mae, which a lot of people don't think about Ginnie, but she's there. And so Freddie Mac and Fannie Mae are two entities where they buy the 30-year mortgages. And so what happens is, when they buy the 30-year mortgages, they are in fact printing money because they are causing there to be demand. When there's a demand for a mortgage, the interest rate goes down. Because supply and demand controls everything we do. Right? It's the force of nature. It's been the force of the world forever. Why did Christopher Columbus come here? Money, right? But we're taking supply and demand. The Muslim traders would not let Christopher Columbus go through Constantinople on the Silk Road to China. They would not let them go through. So you remember Vasco da Gama? He sailed in Portugal, around Africa, and went that way. Christopher Columbus says, I think I got a faster way. I can make some more money. So he goes west. Right? So it all comes down to supply and demand. The price for those silks was super high because it was hard to get them, it was hard to get there, it was hard to get those spices. So we're going to bring the price down by getting there faster. Right? That's what the whole plan is. It's the whole idea. And so that's why we're sitting here today in Manchester, Tennessee. It's because of supply and demand. There was a lot of supply of land, and there was a lot of people in Europe that wanted it. So where'd they move? Manchester, Tennessee, and they called this place Manchester, Tennessee after Manchester, England. because that's what they wanted the city to be like. It's not hard to figure out, right? And so, when the Federal Reserve started buying mortgage bonds and treasury bonds, that causes interest rates to go down. Interest rates go down, it becomes cheaper for Genesis and Kimberly to buy a house. Because if they pay less interest, their payments what? Lower. And so when you do that, you cause the price of homes to do what? Go up. It's a little bit misleading, right? They get cheaper, the payment gets cheaper, but what gets more expensive? The house. So the unintended consequence is, and we're seeing that right now, is you let this go on too long, the prices of houses get so expensive,
Which they are now.
that it gets harder for them to afford it. Because everything moves together. And so that's when you call it, you could say, it could be in a bubble, it could be in something else, but it's hard to say. But that has a huge impact on the value of this property, my house, and all your houses. So the only people that benefit truly in that situation are people that buy early before they go up. And people that had two homes, right? Because they can sell one. Or they can have some expense. Because everybody can have some place to live, so you got to move. And so the Federal Reserve did this. Now, as we know, this word, this term, inflation, we've been talking about inflation in every investment insight since September of last year. Because in my opinion, I believe that they keep doing this, we're going to see more and more inflation. So, the Federal Reserve is in charge of two things. They want people to have jobs, and they want inflation to be low. So, based on those two mandates, what should they have done this summer? Raise interest rates and stop buying these bonds to cause home prices to get cheaper. What did they not do? And the reason why they said they didn't have to raise them is because for the last 20 years, inflation has been low. So we're just going to say, we're just going to average it all together over a 20-year period and not look at it on a short-term level. Here's the problem, right? Kimberly and Jessica said they don't have a house. Once they did something this weekend, I don't know. Which I'll be mad about. They didn't talk to me about it first. And so they go in, and what are they thinking? What do you think, Kimberly? Do you think houses are going to be cheaper or more expensive next year?
Expensive.
So you're like, every year it's more expensive. So what is the urge to do? Buy before it what?
Gets more expensive.
So that causes the price to keep going up even after the Federal Reserve stops, because people are like, I better get it now before it. Remember what happened to OSB board or particle board this summer? It went from $9 a sheet to $50 a sheet because people couldn't find it. So what did people do? Well, I found some, I better get some. You know, I think there was a great example here is toilet paper. So all these people were hoarding toilet paper last year. And somebody got the idea that I'm going to charge more money for toilet paper than I charge now. And everybody said that is discriminatory. How are you charging poor people more for toilet paper? But let's think this way. Let's say a roll of paper costs $30 for toilet paper. You think people will be hoarding it? Nope, because they couldn't what? They couldn't afford it. So if the stores had done the smart thing, instead of limiting how much you could buy, they charge you more for it. Because people would naturally, they'd look at it and say, like I would say, I'm not going to spend more money on that suit jacket. When it was raining today, I'm like, I'm going to take this jacket off. I thought taking my shirt off, save my jacket, right? Because it's $400, right? I got a towel. I just want to swim it. And so that's what I'm thinking in my head. And so people will find another way. And then if they'd done that, toilet paper would never have been out of supply because people are buying extra to what? To hoard it. So if the price goes up, they go down. And so that is the laws of economics. So the Federal Reserve when the first of this correction started, Jerome Powell was testifying in Congress and said, you know what? I know we've been telling y'all we're not going to raise interest rates until the middle of next year. We might want to do that sooner now. And we're going to talk about it in our meeting next week. Now, what is the market not like over anything? Uncertainty. So when you go on record and you tell people, we might have changed our mind, you must be an idiot. Because what you should have done is either change your mind or don't. Don't leave people hanging, make a decision. You know, it's one of the worst things here, if I'm an employer here, and Genesis is like, I'm not sure tomorrow if I have a job. What's she going to be thinking about all day? Her job. Whereas if you said, you're here or you're fired, you know what to do, right? Either stay or you find something else. And so it's my job as an employer to make it really clear, very simple, because it keeps people being more efficient. You have a job or you don't have a job, right? And so that's the right way to do things. What are you laughing at? But the thing is, that's what people don't like. People don't like, hopefully Kimberly's not thinking of something. I don't know what she's thinking about anyway. I give Kimberly a hard time, because she turns red. And guys, and me, I just love, making her red. Poor lady. She comes here, she's like, first perfect fine. I lost my tire today. Don't quit being mean to me. And so when we look at investing, it works the same way. And so right now, the reason why the market's been so volatile, break it down to everything, is part of it's the COVID virus. And part of it is, let's be honest, right? If you're a cruise line and you watch a video where the COVID virus goes from room to room, anybody ever been on a cruise ship before? Are the rooms far away from each other? No. They'd be like me. I'm talking to Brett the whole time like this. It's uncomfortable. But imagine if in a normal hotel room, the COVID virus could go from here to over there without us even touching it, you get infected. Is that good for cruise ships? No, because what's going to happen to cruise ships? They're not going to be sailing. Now, you know what it is good for? Florida beaches, right? Because COVID doesn't spread so well when it's hot and when you have open air. So, the problem on a ship is you can't really open up the ship because they'll sink. You know what I mean? And so, when we start looking at, part of the reason why we've had a little bit of a correction is some of these companies that would not do well, I'll be more frankly, if you're going to travel overseas right now, you guys think it's cheaper to travel to Africa now than before?
Probably.
Oh, yeah. Start booking some deals. You get some cheaper prices. Because here's what happens. As the costs go down, as demand goes down, and supply goes up, what happens to price? You get $20 jackets. Right? So we all want. And so when we look at, yeah, it makes sense. It makes sense that a cruise ship stock should go down. That makes sense. Now what doesn't make sense is other companies like Amazon going down 10%. Unless it's connected to, the Federal Reserve. The Federal Reserve has the biggest impact there. And so that is, when we look at what's going on here, that's the biggest indicator. And this is what's going to happen, because now we have fresh uncertainty on interest rates. And now that we have fresh uncertainty on interest rates, we're going to see more volatility. Now here's the good news. Eventually, they'll make a decision. But until they do, the market is probably going to drop. It's probably going to go down because we don't tend to go up when there's uncertainty. We tend to go down when there's uncertainty. And so generally the market. Now, here's the thing. The minute they make the decision and the market knows clearly about it, what's probably going to happen? It's going to go up. Most of you guys were here when we talked about the presidential election last year. And I said it didn't matter who wins. We just don't want to know who the winner is. Because when we know who the winner is, we're going to pick investments that benefit that person. And I'm not saying it doesn't matter politically, I'm just saying from an investment standpoint. And so, when we look at the reason why, one of the main reasons why the stock market tends to do well the first year of president is because they know who the president is and what they're going to do. You know? And so that is, if you guys remember, we had a president named Barack Obama, and when he was president in 2009, he did the State of the Union speech. And he fluffed it up. So after the financial crisis, he came in as president, as a college professor, he was president of the United States. And at first, when he won, everybody felt pretty good. The market went up big. Then he got on TV and started stuttering, struggling with his speech, and everybody got nervous because they didn't know what he was going to do. So we saw the very low of the stock market related to uncertainties around his policies because he had a 60-seat majority in the Senate, majority in the House. Now, once his policies came out, once people knew what he was doing, the market recovered very quickly. But when the uncertainty hit the maximum level, the market also hit the lowest level it's hit in 25 years. So that is something that factors in there too. So uncertainty is always the big killer on investments. So now we have our option. What is the Federal Reserve going to do? We know they're going to do something. We just don't know exactly what it is. So let me give you guys, if you are a Federal Reserve chairperson, if Kimberly back there and just is, are all the board of the Federal, by the way, there's 3 positions opening up of 7. So apply quickly. So they're all new, which also doesn't help. But let's go with option 1, right? Option 1. The federal government spends another $2 trillion on stimulus. Right? That's option 1. They spend $2 trillion. They spend a bunch of money. And what is this going to do? So inflation's going to go up. They're going to have to do what? Raise interest rates. Which is going to mean it's going to negate all this money they just spent. Because if you remember President Trump when he got elected, he cut taxes. But when he cut taxes, the Federal Reserve decided to raise rates 4 times while he cut taxes. A lot of people said, hey, that tax cut didn't affect my life. Yeah, it did because they also raised interest rates at the same time. So in order for them to actually benefit, they got to work together. Say I'm coaching basketball. And if we don't play together, it doesn't really matter what we do. If one player is really good, but the other 4 will let him walk in the goal, we lose. You know, one person can't win the game. Unless he's Michael Jordan. Anyway, so option 1 is they spend another $2 or $3 or $4 trillion. Which means the Federal Reserve is going to see lots of inflation, which means they're going to raise rates really quickly. That's option number 1. Also, in this option is energy prices. Now, I don't know if you guys knew this or not, but Saudi Arabia agreed to produce 500,000 more barrels of oil a day in the market January 1 and tried to bring down gas prices. Now, I don't know if you knew this, but American, we produce 2 million barrels a day less oil today than we did 2 years ago. Because we are not drilling for oil like we were. So you want to know the number 1 reason why your gas pump is going up? Well, there's 2 million barrels a day less oil being produced. 2 million less barrels a day means less supply with more demand, which means the price goes up. That's an option. Okay, another thing to factor in here is, let's just say that doesn't happen. This bill gets killed. They don't do the stimulus money. Then it's, and the Federal Reserve raises interest rates a little bit, just enough. Then inflation's going to what? It's going to go down. We're going to have some certainty. We're going to know what's going to happen, and the market's going to move forward, and we're going to go up. That's an option there too, right? Another option is We get a third COVID wave, right? But here's what's different. If you look at what's going on in Europe, Europe has a major COVID wave right now. They are not shutting down their countries for everybody. Who are they shutting the country down for? Nope. Foreigners are still going. Austria is shut down for foreign travel. But Germany and France show what they've done. I went to France this summer. If you're not vaccinated, you can't go to a restaurant, a movie theater, or go out of your house, basically. Austria is a policy where if you don't get vaccinated, they're going to fine you $4,000 a year at tax time. Yeah. So when you go to file your taxes, just like, if you guys remember, they passed a law called the Affordable Care Act. In that law, if you didn't get health insurance, you got what? Fined. So it's the same kind of idea, right? We'll fine you. You have to get vaccinated. How are they going to enforce it? They're going to throw me in jail? No. They're just going to take $4,000 from you at the end of the year. And then if you don't pay your taxes, you will go to jail. And think about it, if that can't happen in America, what do you mean? We've already established a precedent where we did the same thing. The Affordable Care Act said, right, you don't have insurance, you have to pay a fine. And everybody said, well, it's not constitutional. It wasn't until that law held up. And so that's one thing here. So if we get a COVID wave and they say, you're vaccinated, you're free to go. You're unvaccinated, you're stuck at home. What's happening to people? What do people start doing? They'll start getting vaccinated. And COVID cases start going down. At least severe cases. So that's an option there. But what's really important is it's very, very, very unlikely the country would shut down again. What's more likely is they would shut down certain parts of the country. So if you go to Germany, Saxony is shut down and so is Bavaria. But the 14, I think there's 16 districts, are not shut down. Only 2 of 16 are. So what they're basically saying is, we're going to shut down the state of Tennessee, but we're not going to shut down Georgia. That's basically what their decision they're making is. I'm not saying it's the right decision, but that's what you're seeing. And so, but here's the thing. We've already been through a shutdown. So the market knows what to expect. So if the market goes down, it's going to be short term because the market doesn't care about what's happening if they know what's going to happen next. They care about this magic word, which is uncertainty. So the good news is, since we've been through it before, we know what to expect. So the biggest issue right now is not COVID. It's the Federal Reserve. What are they going to do next? And the worst part about the Federal Reserve chairperson is, he still made a huge mistake after getting reappointed. He doesn't understand how to remove uncertainty. He'd be better off just doing it than what? Playing with it. And I feel like some of these people love the power too much. They love being known for the power. Whereas the best thing about Alan Greenspan was he was Federal Reserve chairman for years. And Jerome Powell made it there too. No one could understand what he was saying. He made up words. Every time he spoke, you're like, you ain't gonna do that. That's pretty much what happened. Okay? So as we look at investors, this is not a long-term problem, right? I mean, U.S. companies, I'll give you some numbers here on U.S. companies. Is for the S&P 500, earnings trade at 20.4 times earnings. So the market is now 7% cheaper than it was last time we met. Now the market hasn't gone down that much, but profits keep going up. Earnings growth for this year, this quarter, is probably, they expect it to be 20.9%. But it's probably going to be between 24 and 30% higher than last year. We're going to have an amazing Christmas season. Revenue growth rate is expected to be 12.7%. But here's the big number. For 2021, the expected profit growth rate for U.S. companies is 45% higher than last year.
So I saw an article the other day that I couldn't read it because I didn't have a subscription to it. They said something about the Santa Claus market, is that what?
Well, typically, which is not what we're seeing right now, but typically during the Christmas season, which is right now, this statistically is the best time for the month. People are feeling good, people are investing, it's a positive time. And if Jerome Powell hadn't spoke last week, that's what we'd be experiencing today. Now, I think he should have already spoke. I think the market should have already dropped this summer. That's my personal opinion. Because I think they should have raised rates then. They should have tried to bring real estate, the big increase, they should have tried to bring that down. That would cause inflation and all that.
What effect will the jobs market have on it? Because I know there's a big drop in that.
Well, that's why they like that. When the jobs go down, they just keep rates lower. But we don't have a jobs market because there's a lack of jobs.
Nobody to fill it.
We have no one to fill them. And so our country, regardless if people believe this or not, we need immigration. We need to bring in people that want to work to America to fill those jobs. Because if you think about it, people that want to work at a waitress or as these service jobs, those jobs are typically people that don't have a lot of education that work really hard. And that's what our country needs. But we're going to get either way. I mean, people are like, well, there's always illegal immigration. Why is there illegal immigration? Supply and demand.
I did see where in Texas they're going to build a $17 billion factory to build these chips.
Yeah, Texas and Austin, they won that computer chip. There's all these jobs in America, but there's no what? People that want to work to fill those jobs. So we need people that want to work.
This probably wouldn't include people that want to work, but the welfare law is gone and stuff like that. If that were reduced like Reagan did years ago.
Well, the thing about it is there's not really, it's a weird situation because it's not where the welfare roll has gone up. No one really knows where the 8 million people that aren't working that should be are getting money from.
Is it from the stimulus?
Some of it people think could be because they have stimulus, they're sitting on cash and they're not working. But a lot of the people that aren't working, there's two main groups that aren't working. It's women with children and African Americans in cities. And if you think about it, which I don't know the answer, I can only hypothetically put it as, a lot of women may have said, you know what? I can stay home with my kids. Maybe I don't need as much money to get by to work. Right? Could be. But then once inflation comes in and things get more expensive, they're going to figure out what? They got to work to pay their bills. You know, when the price of chicken is double what it was a year ago, they want to get food for their kids, they got to work. Then, if you look at cities, a lot of African Americans live in cities. And so, a lot of the cities have been shut down for COVID. People aren't going to the city out to eat. They're not going, you know, like if you're in Los Angeles lives and breathes off of people coming here from other countries. Well, they aren't coming because they've been shut down. Till about a month ago, you couldn't even enter the United States as a foreigner. So, think about what that does to New York City. Then think about how many, if you ever, I worked in Japan. You know what every Japanese person tells me where they have been? I've been to America. What 2 cities have they been to?
Los Angeles, New York City.
Los Angeles and New York City. Now, I would tell you, where I'm seeing Manchester, that's not America. Because my America is what? Manchester and Nashville, those kinds of cities. But they haven't been there. So they say they've been in America like, I've been to Los Angeles, I've been to New York. Well, man, those cities look a lot different than where we are right now, for better or worse. And so, but a lot of those cities depend upon tourism. And so I think, if you look at, there's an article on Friday, which showed that there are less jobs in cities today than there were 6 years ago. I think the jobs have been created, but they've been created in the suburbs and in rural communities. They're not being created in the cities. And I think it's because a lot of city revenue comes from tourism, or, you know, like we did our office Christmas party, went to Nashville. We go to Nashville, we spend a bunch of money from here, in where? Nashville. And so, that creates jobs, not in Manchester, but in Nashville. You know, since I pick on Kimberly all day, I pick on Genesis. So we were doing top golfing. You wouldn't believe it. Genesis was really close to beating me in golf, but then the last 10 shots, she just couldn't do it. But she had me down. But there is no top golf in Manchester. That's an experience we're only going to get if we go to Nashville. And so that is the situation. And so when we look at investment, though, we are seeing an uneven recovery. But it's related to how different areas are dealing with COVID. Florida opened up. They never closed. But then the cruise ship industry around the cruise is waiting. Because all those people that bring food to cruise ships, they're not working. Because the cruise ships aren't sailing. And if you're on Broadway, I don't know if you guys know this, but all those actors and all those people around there, they didn't have jobs for a long time because no one's going to those shows. Well, a lot of people fly from Japan, they'll go to Broadway, they go watch Hamilton. I want to go see it. But that's somebody that's coming in from another community to spend money in America. So what we're seeing is, in the recovery, is uneven. But it's uneven because of how people make their living. And so that is what I think is it. That's my hypothesis. But we don't know. We don't know the answer. We don't know why. We know for sure one thing, that a lot of people decided their investments were up and they retired. A lot of people made the decision that they had enough money at this point, they're going to go. And they just retired. A lot of babies retired. And we always knew that was going to hurt employment. Because there's not enough of my generation to replace the baby boomers. So the only way, it's like, talking about schools. Schools are really struggling right now. Because all these schools were built for me and my generation. And then after my generation, Genesis and Kimberly's generation, there's a lot less of them than there are millennials. And so there's nobody in these schools. And so the only people that can come to those schools and be there were foreigners. And guess who can't come to America? They did a study that said that by this year or 4 years ago, in order for schools to maintain their enrollment, 40% of the kids have to come from overseas. And then we shut down our border, so they can't come here. So what does that lead to happening to education? Those people will be paying. By the way, if you come here from people like you have a hard time with people that are from overseas. But you know what I want to Pepperdine, right? The people that come from overseas, they get no financial aid. So Pepperdine now is $77,000 a year to go to school. So if somebody from Manchester goes there, they're probably only going to pay $20,000. But somebody comes there from India, they're paying $77,000. They're paying full price. That's a huge benefit to our community because they're bringing all that money here. And so I think we don't really know. I do think part of it is, and we're going to find out after Christmas, is part of it could be a lot of people got caught up with their bills when they got all the stimulus money. But what's probably going to happen on Christmas? They're going to spend it. They're going to go back into debt. And they're going to wake up in January. They're going to be like, need some money. Got to go back to work. And, that's the whole thing. It'll happen either way, right? Because if people don't come back to work, inflation will make them. Because it's like people talk about the welfare system. Okay. But think about what it costs for food right now. So if food goes up 20% and the inflation index only goes up 5%, it takes you 15% more to buy your food. Which means you gotta what? You gotta go to work.
I heard coming over here on the radio where somebody in one of these institutes or something done a survey. And they said for the next 2 years that inflation is gonna go higher.
Well, it's hard to say.
They were just on something they say that I don't know.
Went over and over, but I think the biggest thing with inflation right now comes down to 3 factors. Federal Reserve, government spending, and energy prices. If we started producing 2 million barrels of oil more a day, inflation would go down. Because the price of gas would go down. And when the price of gas goes down, the price of everything else would go down too.
The only way that happened, you have to change administrations of Washington problem.
Well, it's interesting because most of the drilling that occurred with oil happened when President Obama was president. And he was anti-oil drilling. So the question is, why is that happening? I think it's more complicated than that. But we won't talk about that today. So, but anyway, investment insights in educational space. We do our best to provide information. Please seek out competent legal, tax, and financial advice to your unique situation before you make a decision. Thank you for tuning in today. Have a great day.